Good afternoon. This is Ken Long from Tortoise Capital Management with a review of the weekend reports for March 5th, 2011, followed by a quick look at the daily trading plan for Monday. To begin, we're looking at a bullish normal market that's overbought on an annual basis, just on the lower boundary of overbought with the weekly RSI. On a 10-day basis, it's right in the middle at 56 on the 10-day NDX. The stretch above the 200-day moving average and the slope of the 50-day moving average are both coded green, so they're still very strong and rated bullish. ADX has dropped from a high about 4 weeks ago, greater than 35, all the way back down to 17, and it is neutral trendingness and dropping, and we'll see what that looks like here in a minute. The ATR percentage has climbed to 1.21%, and that's at the upper edge of the boundary of normal. As we've gotten into this choppy trade here in the last 10 days, volatility has begun to increase markedly. So we got a bull normal market. That's good. The market is neutral on a short-term basis. The U.S. is above average in strength. Asia is still lagging. Precious metals and energy of any type dominating. Silver just continues to march northward. It's at a multi-decade high and not looking back. Agriculture should continue to benefit from crisis in the Middle East, oil challenges, and rising food prices. The monthly rebalancing, there's a little misprint in here that should read IWM, EFA, and EWA with a reevaluation on or about 1 April. Quarterly rebalancing is also due 1 April, and it's still holding the techs, U.S. mid-caps, and U.S. small caps. The theoretical exposure of ETF2 goes to 100%. The model portfolio also goes to 100% by adding 2 positions, one in silver and one in XLE, with a note to update your stops on the holdings that we already have. XLE, we'll see, is my recommendation for the energy sector. There are so many to choose from that it makes sense to take advantage of the broad sector exposure that's in the S&P energies, along with a little bit of conservative strength in the U.S. So that's why I'm choosing XLE for the additional energy position. In the market health check, this is kind of a remarkable condition here. You can see the vertical blue lines are lookbacks from 10, 20, and 30 days. The purple horizontal line is the swing high of about 135 that we got to back at the third week of February. The horizontal red lines represent previous support levels. I've also added these 2 little blocks here that represent a 5% swing from the swing high and then a 10% pullback from the swing high. So you can see the 2 boundaries of pullbacks that we can think about. Anything less than 5% we can think of as normal noise in the market, the normal breathing in the market. We've tested that a couple times in the past 10 days. And then if we get all the way down to a 10% drop from the swing high, that's when market pundits will start talking about a normal correction inside a bull. So we're still well within noise, but you can see already how choppy it has gone from 60 days of almost uninterrupted gains in one of the strongest 60-day moves ever in SPY's history, and how quickly it goes to 10 days of sideways chop. But we're still well within the boundary of normal. It's been tested twice at about 130, and so there's still reason to believe that the bull has legs, but we're just going to be careful about it and respect how quickly the tide changes. Now you can see 30 days ago, a little over 30 days ago, the ADX, the strength of the trend in the market, got as high as almost 35, and it's been declining steadily as we've added chop and a little bit of sideways market, and now it's back down under 17, and you can see how starting 10 days ago, the minus DI has now up here with plus DI and starting to compete. So that's sort of the definition of a pure sideways market within these last 10 days. Price still closed above the 10-day moving average, however, which is above the 50, which is well above the 200-day moving average, which can be found down at 116, which would be the vicinity where we'd start talking about sideways and bear-type markets. 10-day Williams percent R, we saw a channeling and overreaction signals in here that were lucrative and sold right at the top of that red candle, which was nice. It's come back to test and had another nice little bounce, but you can see it's having trouble getting through 134, and that's cause for some concern. But as long as it doesn't violate 130, then it's reasonable to see it continuing to test the swing high up around 134, 135-ish, and then a breakout from here, for example, above 135 would be considered very, very bullish indeed. And that could signal the start of a third leg up. So we're right at the moment of hesitation here. It's still fair to call this a pause after a terrific 60-day move, and we're still within the range of market random pullback, random noise. This is just the market breathing. But if it breaks below 130 and then doesn't, it'll be testing the 50-day moving average and then a breakdown from there. It could get ugly in a hurry with a quick shot down to 125 as part of the next leg down. So that's the market health check. Inside ETF2, all 10 sectors of the world market model, the middle ring, are in the green, so that takes us up to 100% theoretical exposure in the market, and coming up from 80, from an 80-20 split. Again, we're in bull normal mode. The S&P and EFA are just about identical now, so the global markets have caught back up to SPY. Nice move off the bottom in Europe and Latin America. In the U.S., the mid caps are better than the small caps, are better than the large caps. The two weakest sectors are Asia less Japan and then emerging markets. And then the strongest sectors still are U.S. mid caps and U.S. small caps. Inside the world market model, a little more detailed look. You can see the large caps in the U.S. are lagging behind the U.S. smalls and mids. Asia is still suffering relatively compared to Europe. You can see energy is just absolutely the dominant market. It's interesting to note that healthcare has started to move up. The three defensive sectors over the last 3 or 4 weeks had been lagging considerably, healthcare, staples, and utilities. But it looks like healthcare is starting to emerge as the leader among the defensive ones, and that's one that we ought to think about with XLV. Keep our eye on that one. Clear strength now in the other asset classes. Commodities, oil, gold, silver have been dominating at the expense of treasuries and bonds. How much more room is there in there for them to go? Well, there's no resistance overhead, especially in silver. Oil has a sort of a natural industrial regulator on it, but gold and silver, who knows? We'll see. I think that explains some of the strength in Canada because of its natural resources. And you can see Brazil and Latin America have come off the bottom. They've left really the rest of the emerging markets behind and have now caught back up with the U.S. and most of Europe. Inside the 100 by 200 crossover, I don't trade this directly, but it is an indicator of general intermediate term bullishness or versus bearishness, kind of a intermediate health check, if you will. Everything now as a price better than the 100-day, better than the 200-day moving average, except for utilities, treasuries, and emerging markets. Treasuries are the only one where the price pattern is inverted and suggests a potential short. So everything looks fairly healthy across the world by those measures. Inside the ETF top 30 from the ETF2 database, this would be a good place to pause the movie if you like. And I'm not going to read them all, but it's absolutely clear that you have silver, precious metals, any form of energy, and commodities are going to be found in here. It's not till you start getting all the way down around IGN and PGF, PFF that you see anything else even begin to appear. And that's where networking, technology, and financial preferreds can be found. So it's all the same usual suspects. This trend has been lasting at least 8 weeks. Inside the ETF liquidity review, it's interesting to note that gold and silver now have silver has almost cracked the top 10 on daily dollars traded. And you can see the highlighted green ETFs are those that have exceptional intraday volatility and are good targets for shorter term or intraday traders. You'll note the VIX continues to lead the way far and away with over 5% intraday volatility. So that's not all bad. Finally, the ETF2 summary. You've seen most of those charts already, so I'll just leap right to the model portfolio. And you can see that we'll be adding a second position in XLE and a position in SLV. And the only thing of note on the current holdings is technically, could we sell QTech? Yeah, that's an S&P. I'm sorry, that's the equivalent of more of a NASDAQ 100 feature, but in my judgment, it's worthwhile holding on to that for another week. We already own the position. We've been making some money on it faster than other positions. The protective stop will protect the capital. The market went from 80-20 to 100%, and so I'm willing to let that go for another week and see what we can see. If it continues to lag a second week, then that would be a candidate to trade up. My concern is I don't want to have too much exposure to the energy and commodity sectors, and having a basic index here is not all bad. And an update of the stops, and this is based on Friday's close for silver, tentatively, and then XLE. You should use the stop of the original position, and that's still fairly close to a 10% trail. Now we'll pause for a moment and shift to the daily report. Again, you can see the market mosaic across the top. I'm going to go straight to the gap stats now. And what we have is gaps have been reversing now only 46% of the time. You may recall about 3 weeks ago that that was something like 70% of the time the gaps are reversing. Now they're not. 11 times and 4 times in the past 30 days, the market has gapped down. So 15% of the time it's gapped down, 15% of the time it's gapped up. When it's gapped down 11 times out of 15, it has reversed to close higher. And only 4 times has it gapped down and continued to fall. But that number's starting to increase as we've gotten a little bit more sideways market. On the gap ups, it's also gapped up 15 times. 12 out of 15 times the gap up has been followed by a gain, and only 3 times has it reversed. However, what you'll notice is when the market is gapped up and then reversed to close lower, the return has been 3.5 times larger than a gap up and go. And so we're starting to see a new pattern beginning to emerge as we get into the sideways trade, and that is gap ups, when they fail, are starting to get crushed. So that suggests to me that if you're buying early in the day, you should be prepared to cover and reverse if your follow-through does not materialize. In other words, if it gaps up and then collapses, when it breaks below the opening on the gap up, that becomes a very lucrative potential trade. I've seen that in the small caps. I've been practicing my trades on the Russell E-minis, and that's been a very good idea. You can see on the intraday range stat now, in the gap stat for SPY, the standard deviation is down to 0.66. The intraday move, the boundary of rational exuberance in SPY has been 1.9%. You can see the 10-day index, we're starting to get some sideways chop in here when we're just about the 50-yard line. No signals in overreaction or channeling. You can see the pivot points. You'll notice how the volatility here has now increased to just about the boundary of noisy or volatile. So we've traveled from 0.55% intraday volatility, the ATR percentage, all the way up to 1.2. So volatility in the last 2 months has increased almost 200%. You can see a summary here of the 10-day min pain and max pains. Walmart continues to have my attention, as does Alcoa. With strength in commodities and then relative weakness in Alcoa, there may be a pullback buying opportunity inside Alcoa and Home Depot. In the ADX, again, you've seen this before from the health check, but you can see how it has degraded and how the plus DI and minus DI are now grappling above the line. That's the definition of a sideways kind of a market. Now I've changed the formatting of the patterns a little bit. Hopefully it's a little easier to read, and I had some room now to add a few more. And I'll be recording the ETFs that meet these different patterns in this first column, and then the large caps, usually the Dow or possibly some large cap favorites of mine if they're outside the Dow, and I'll record those in here. If it's a sign of weakness on the pattern, such as like the elder safe zone getting weaker, then I'll have those tickers in red, and this maybe make it a little bit easier to read the pattern trades. Looking at the tactical Dow, we can see the percent losers: Hewlett-Packard, General Electric, and American Express. I like Hewlett-Packard only because it continues to be a max pain on a 10-day and 3-day, and it was a percent loser on Friday, which makes any potential rebounds in that very decent intraday, day one type trades from max pain conditions. The leading contenders: Boeing, Johnson & Johnson, and Merck. Merck has some possibilities as well. The percent gainers on Friday: gold, silver, and oil out of the basic commodities. And you can see financials and industrials are max pain here on a 10-day and a 3-day. And that's why I would have American Express on my short list for tomorrow, because the sector is in a max pain, and yet so is AXP. So that becomes a potential for a short-term washout kind of a trade. In the Dow summary, you can see we've got a handful of dojis and some channeling opportunities here in Procter & Gamble, Microsoft, and JP Morgan. Microsoft continues to be a very close stock for me. I like the way that it's shaping up on a reward-to-risk basis. We'll see that in the auto framer. Triple screen patterns in Home Depot, IBM, and Travelers. Travelers is also our only 551W. Hewlett-Packard is our number one max pain range compression, followed by Walmart, JP Morgan, Bank of America, and Alcoa. Inside the ETFs, almost no patterns at all. We had some dojis in coal and DBC, the blended commodities, and that looks promising. But max pain range compression still in natural gas is now hovering just around 5, and we know that its one-day moves can be extraordinary. And here we have something didn't quite make a percent gainer, but while everything else was suffering, and while it has been suffering over these multiple time periods, it was actually a percent gainer on a one-day basis. So if it holds at 5, you can trade that one intraday with a very tight stop if you are quick on the trigger. Looking at some additional market indicators here, the slope of the regression line, you can see the R-squared is down to 0.45, and that represents how much that positive trend up is being broken by this choppiness, so R-squared quickly starts degrading. You can see here on the time series, the slope of the regression line has now gotten all the way back to the average of the last 6 months. This is what the trend of the last 6 months has been. This little peak up here at 135, just above 134, was the tail end of one of the strongest periods of improvement over the 30-day periods. You can see that here the two legs up with these two little hesitations here. That's on a percent stretch basis. It never quite got to 2 standard deviations above and is now hovering just above 1 standard deviation. So still powerful move, but definitely we're in a consolidation zone here. It has to stay above 130, which you can see that it's tested twice, to really give us an indication that a third leg in the bull up is possible. Otherwise, a pullback down to 125, as we saw in the health check, is the next indication. You can pause the tape here or look at the daily report for range stats and gap statistics and the quality reports, and both for the Dow and for the ETF 30. I'm calling this the alpha stat. This is the what we've done here is I've taken that regression line slope of 10 of the major indexes in the world market model, subtracted that of SPY, so we get something like a normalized sector alpha. So in this case, the 0 line represents SPY in every case. And what you can see is all the U.S. indexes have pulled back to the 0 line, back to SPY. For a while, we had the small caps outperforming, but they have suffered a lot the last couple of days. The short side's been a very good trade when they failed. And now you can see perhaps a flight to quality in the U.S. with the diamonds, DIA, coming back from the bottom and now rejoining. So everything is merging back to SPY. I think we're seeing a flight to quality and people looking to lock in the gains of those last 60 days. Down here in the three commodities area that I'm looking at, DBC, oil, and gold, you can see how they are just really starting to take off. And right now, oil is 3 standard deviations of strength above that of SPY. Hard to see how that gets sustained. Could it? Oh, sure it could. Things can stay irrational longer than we can stay liquid. However, that has really been an extreme move. That's been a move of almost 4.5 standard deviations, just in the last 30 days, with oil going from underperforming the market to all the way above. That's what global instability can do to us. And to the price of oil. And then in the internationals, you can see here that emerging markets have caught way back up and are starting to roll over. And Japan is starting to degrade after its nice, gentle 2 standard deviation move. So they're coming back to the U.S. What really remains standouts right now are ILF and EEM. And by extension, Brazil on the long side has been a intraday target of choice for me as well. Only Latin America got measurably stronger among the usual suspects using the Elder's Safe Zone channel, the way I've adapted that. And I'll let you pause. You can stop the tape to look at the top 15 winners and losers, the daily pivots, the holding periods, correlation coefficients. And one thing I'll just talk to briefly on here is we can ask, how tight is the 30-day correlation among the major indexes? What you see over here is a z-score, or a statistical view of how tightly correlated these 10 sectors are with SPY. When you see them converging that tightly, that has ordinarily been a time when the market is starting to go choppy or threatening to roll over. You can see here 30 days ago, before we got that sideways chop, at the end of that 60-day period, the correlations had gotten quite extreme, quite out of whack with that of SPY. And that's typical behavior when the markets are going up and money is starting to chase and differentiate between the different indexes. When things start getting a little bit uglier, a little bit threatening, it's remarkable how quickly those correlations can converge. And you see that the spread between the most correlated and least correlated is not very much at all. And on a historical basis, that correlation is really still pretty tight. So I look at this really to help me appreciate what's going on with the market, and sort of an additional look at fear in the marketplace. And we can see people starting to tighten up just a little bit here in that indicator. And that's all from the daily trading plan. This is Ken Long from Tortoise Capital, wishing you good trading. Remember to plan, prepare, and execute your trade.